TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
Imagine buying a lottery ticket at breakfast, right? And by lunch, it's paid out at 233% return.
I mean, yeah, that sounds pretty good to me.
Right. But now, imagine that happening while the actual lottery numbers haven't even been drawn yet, because that is exactly what happened on a seemingly quiet Monday in July of 2026.
Yeah, the Apple trade.
Exactly.
Yeah.
A trader bought a stack of options on Apple. The broader stock market didn't move a single inch all day, and yet in just 2 hours, those options just absolutely skyrocketed in value.
It's totally counterintuitive to how most of us are taught the market works.
Right. Because, usually when we think about a market crash or like extreme volatility, there's this expectation of a very clear fundamental cause and effect. A company reports terrible earnings or some frightening economic data comes out, and the market drops. It feels logical. It feels proportional.
It feels like the news is the steering wheel, right? And the market just obediently turns wherever the news points.
Yeah.
That's the traditional view anyway.
But then you start digging into the actual mechanics of modern trading for a deep dive like this, and suddenly that traditional logic just completely falls apart.
Yeah.
You realize that sometimes it's not the news that determines how violent a crash is. It's the invisible plumbing underneath the market.
Yeah.
This unseen architecture that is dictating, well, everything.
It really is the absolute definition of the tail wagging the dog. The plumbing has become, bigger than the house.
And uncovering the plumbing is exactly our mission for you today. We're going to explore how a market transitions from a totally calm, artificially stabilized environment into just an absolute chaotic mess.
It's a fascinating transition to unpack.
It really is. And to do this, we're looking at a great stack of sources. We have a daily sequence of financial notes from Spot Gamma covering a very specific turbulent week. So July 20th to July 24th, 2026. And we're pairing that with an analytical case study appropriately titled Anatomy of a Market Break. So to kick us off and just kind of anchor this whole discussion, what is the core premise here? What is this secret to the market plumbing that most of us are just missing?
Well, what's fascinating here is a central thesis that entirely reframes how you should look at your portfolio and really just the broader market in general.
Okay.
The sources make a very clear distinction. They say fundamental news, so corporate earnings, inflation data, geopolitical events that dictates the direction of the market.
Right, whether we go up or down.
Exactly. But the options market structure, specifically how massive institutional dealers are positioned, that dictates the velocity.
Okay, wait. So if I'm understanding this right, the news tells us if we're going up or down, but the plumbing tells us if we're like taking the stairs or jumping out the window.
That is a great way to put it. Yeah. Fundamental news lights the match. A bad earnings report is a real spark. But it's the options market that dictates how much gasoline is poured on the floor before that match is even dropped.
Okay, let's set the scene then. Because reading through the Spot Gamma notes from Monday and Tuesday of that specific week in July 2026, you would never guess there was a single drop of gasoline on the floor.
No, everything looks perfectly fine.
Early in the week, the S&P 500 is just hovering around the 7,500 level. Everything seems incredibly calm. It's so quiet, in fact, that the notes mentioned Jim Cramer was on TV Monday night calling it a miserable market.
Right, because it's just inching along doing nothing.
Exactly. But the sources point out that this calmness is actually a total illusion. It's created by something called positive gamma. And I want to unpack this for a second because this is key. Positive gamma is basically like bowling with the bumpers up, right?
Yes. That is the perfect way to visualize it. But to understand why those bumpers are up, we really have to look at the mechanics of the market makers.
The big institutions?
Right, the massive financial institutions that sell you options. See, when you, as a retail trader or even a hedge fund, buy an option to bet that a stock will go up or down, the dealer on the other side of that trade does not want to take on your directional risk.
They aren't actually betting against you.
Not at all.
Yep.
They operate like a casino taking a rake. They just want to collect the transaction fee, the premium, and stay totally neutral.
I think this is a huge misconception. People think, if I buy a call option, the dealer wants the stock to go down so my option expires, worthless. But they don't actually care, do they?
They don't care at all. They just want their fee. So to stay neutral, they have to hedge. If they sell you a call option, which, gives you the right to buy the stock if it goes up, they are now on the hook if the stock just explodes higher.
Because they'd have to provide those shares.
Exactly. So to protect themselves, the dealer goes out and buys some of the actual underlying stock immediately. This is called delta hedging. They are constantly adjusting how much stock they own based on how the market is moving.
Okay, I'm with you. They're constantly buying and selling the stock just to balance their books.
Precisely. And here is where positive gamma comes in. When the broader market is in a state of positive gamma, the complex math of millions of these options contracts dictates that these massive dealers are forced to buy stocks when the market dips.
Wow.
And they have to sell stocks when the market rallies, literally just to keep their books balanced.
So they are automatically buying the dip. Not
Okay.
because they read a great earnings report and think the stock is a good value, but because an algorithm is forcing them to buy it.
Exactly. They're acting as giant multi-billion-dollar shock absorbers. They are the bumpers in your bowling alley. If the ball starts drifting toward the gutter like a market dip, the dealers mechanically buy, bumping the market back toward the center.
And the sources are incredibly specific about where this bumper actually exists. They peg the critical level, what they call the risk pivot, at exactly 7,480 on the S&P 500.
Right, the 7,480 level.
So as long as the market stays above 7,480, we have the bumpers up. Every little dip gets bought by a dealer algorithm.
And that artificially suppresses volatility. It creates this synthetic calm. It makes the market look like a quiet, sunny day, even if, massive storm clouds are gathering right over the horizon.
But the cracks were already starting to show underneath. This was actually one of the most exciting parts of the deep dive for me. And it goes back to that lottery ticket analogy I mentioned at the start.
Yeah, the Apple options.
Right. If you just looked at the S&P 500 index on Monday, it was completely flat. But underneath the surface, absolute chaos was brewing. I was looking at the spot gamma notes for Monday, and I honestly had to reread this one stat 3 times to make sure I wasn't hallucinating.
It's a pretty wild stat.
They highlight Apple puts with a 335 strike price expiring that exact same day.
Right, those are the infamous 0 days to expiration options.
Yeah, 0 days. And in just 2 hours, the premium on those Apple 0-day puts jumped from $3 to $10.
Yeah.
That is a 233% return in a couple of hours on a day when the broader market barely moved an inch. And on top of that, there's this looming anxiety highlighted in the notes about SpaceX.
Yes. SpaceX was preparing for its first ever quarterly earnings report as a public company, which was set for August 4th, 2026.
And the notes point out that following that release, their first lockup expiration was set to hit. Now, I know a lockup expiration means early investors and employees are finally allowed to sell their shares,
Right.
which was something like 911 million shares in this case. But why was that causing so much panic in the options market specifically?
Yeah.
The sources point out this notable put wall at 125 while the stock was trading around 120. Mechanically, what is a put wall and why does it matter?
Well, a put wall is exactly what it sounds like, but built out of financial contracts. It represents the strike price where the largest amount of downside options, those put options, are concentrated. So mechanically, it acts almost like a gravitational force or a physical barrier for those dealers we were just talking about. Because there are so many contracts sitting at that 125 level, as the stock price gets closer to it, the dealers have to aggressively alter their hedging.
So it creates friction.
Immense friction. It shows that massive institutional money is paying huge premiums to protect against a crash in SpaceX.
So I have to ask this on behalf of you listening, because this is where my brain just started to hurt. If individual stocks like Apple are seeing 200% swings in option premiums, and heavyweights like SpaceX are hitting massive defensive put walls, why does the overall S&P 500 look so utterly calm?
That's the core mystery, isn't it?
Right. How can the index be flat when its largest components are experiencing all this underlying violence?
That is the million-dollar question. And the answer lies in a metric from the sources called the KOR1M index.
The correlation index.
Right. This measures the one-month implied correlation among the top stocks in the S&P 500. Essentially, it asks, are these massive companies moving together as a herd, or are they moving independently? And early in this week, the sources note that KOR1M was flashing a massive red alert.
I saw that in the notes. Was it because the number was too high?
Actually, it was astoundingly low. Usually a reading under 8 on this index is considered a warning sign. The notes had it sitting way down around 4 to 5.
Wow, so really low.
Yeah. This phenomenon is called dispersion. It means that stocks are moving completely independently of one another.
Okay, so it's kind of like a swan gliding across a lake. Above the water, the index looks perfectly smooth and graceful.
Huh.
But underneath the water, the individual stocks are just paddling furiously in completely different directions.
That is a brilliant analogy. Or, think of it like a massive tug of war where both sides are pulling with incredible violent force, but the rope in the middle of the index doesn't move at all. If Apple is dropping wildly because of some internal issue, but maybe healthcare or energy is having a fantastic day, they just cancel each other out at the index level.
Oh, I see. So the index stays flat, perfectly hiding the violent moves happening underneath.
Exactly. Extreme dispersion temporarily masks the broader market risk. It's a bizarre environment because you can have entire sectors getting absolutely hammered, generating terrible headlines, while the overall index sits perfectly still, leading everyone to believe the market is perfectly healthy.
But here's where it gets really fascinating. This low correlation environment actually allowed for these isolated, massive explosions in individual sectors without tripping any broader market alarm.
Yeah, the Tuesday semiconductor rally.
Exactly. On Tuesday, the sources flagged this massive rally in semiconductors. SanDisk ticker SNDK surged 14% in a single day to hit 1,589. It wasn't driven by fundamental news. It was driven by an absolutely insane options trade.
The sheer size of that trade was staggering. It warped the mechanics of the entire sector.
Someone dropped $75 million in premium on SanDisk calls, expiring in January 2027 at a 2,270 strike price.
75 million.
Think about that. $75 million just to buy the right to own the stock much higher, much later. And because the dealer on the other side had to hedge that massive bet, they had to go buy millions of shares of SanDisk immediately.
Right, the delta hedging we talked about.
Yeah, that one trade helped pull the whole chip sector up.
Yeah.
But because of that low correlation swan effect, the S&P 500 barely blinked. It just absorbed it.
But here's the catch with dispersion, and this is exactly what the sources warn about. It never lasts.
It has to normalize eventually.
Right. Eventually, correlation always normalizes.
Right.
And when stocks start moving independently and start moving together again, they usually don't move up together. They move in one direction, down.
So this illusion of calm couldn't last forever. All of those isolated underlying bets had an expiration date. And that brings us to Wednesday, where the narrative in the sources dramatically shifts.
Wednesday was the turning point.
Up until now, we've had the bumpers up with positive gamma, we've had low correlations masking the danger.
Yeah.
But Wednesday introduces a fundamental mechanical shift in the plumbing.
Yes. Wednesday was VIX expiration and the start of a broader OPEX, or options expiration. To understand why this matters, you have to think of those active options contracts as heavy sandbags holding a hot air balloon on the ground.
Okay.
Millions of contracts that dealers were actively hedging against suddenly reached their expiration date.
The bets are officially over.
The bets are over. And because the bets are over, the dealers no longer need to hold those massive hedging positions. They drop the sandbags.
Ah.
The sources describe this as uncorking the market. It frees up equity volatility. Without those hedges pinning the market in place, the market is suddenly much lighter on its feet and much more susceptible to a violent swing in either direction.
And it just so happened that this mechanical uncorking, this dropping of the sandbags, lined up perfectly with a massive fundamental catalyst, big tech earnings on Wednesday night.
The match was finally dropped onto the gasoline.
Yes, exactly. Alphabet beats expectations, but their stock drops roughly 4%, and later it drops 7%.
Right.
Why? Because they issued higher CAPEX guidance for 2026, capital expenditures. Basically, they told Wall Street they were going to spend billions and billions more on AI data centers without any immediate payoff, and the market hated it.
They absolutely hated it.
And then Tesla misses profit estimates entirely and just plummets 16%.
Yeah.
So the fundamentals are undeniably bad. But wait, let me make sure I'm following this logic because I have to push back here.
Sure.
If everyone reading these spot gamma notes knows about the 7,480 risk pivot, and they know the dealers are sitting there with their giant algorithmic shock absorbers, why doesn't the market just magically stop at 7,480? Why isn't this a self-fulfilling prophecy of safety where buyers just step in?
That is the critical vulnerability of positive gamma, and honestly, it's a trap many traders fall into. The shock absorbers have a weight limit. Yes, the dealers are systematically buying the dip to balance their books. But when fundamental news is shocking enough, like a 16% drop in a massive mega-cap stock like Tesla, combined with an Alphabet sell-off, the sheer volume of institutional selling completely overwhelms the dealers.
Too much weight.
Exactly. It's like a runaway freight train hitting those bowling alley bumpers. The bumpers don't gently push the train back to the center. The bumpers just snap. The organic selling pressure pushes the index completely through the risk pivot.
And once we drop below 7,480, we cross the Rubicon. We hit Thursday and Friday, and the climax of the week arrives. The market officially enters negative gamma. So mechanically, what does that actually mean for the plumbing we've been talking about?
This is the real aha moment of the entire case study. When the index falls below that 7,480 risk pivot, the math for the options dealers violently flips.
Flips out.
To keep their books balanced in a negative gamma environment, they can no longer buy the dips. They are mathematically forced to sell into the dips.
Oh, wow. So the exact mechanism that was saving the market on Monday is now actively destroying it on Thursday.
Precisely. It is a procyclical loop of selling. Think of a ship taking on water. In a normal positive gamma market, the bilge pumps push the water out.
Right.
But in a negative gamma market, the wiring short circuits. Not only do the pumps stop pushing water out, they reverse and start actively sucking more water into the sinking ship. If the market drops a few points, the dealer algorithms are forced to sell stocks to hedge.
Which pushes the market down further.
Exactly, which forces them to sell even more stock.
It's an avalanche. And the hard data from the sources paints just a terrifying picture of what that avalanche looks like in practice. On Thursday, the S&P drops 1.2%. The VIX, the market's fear gauge, spikes 12.3%.
It's a huge move.
And remember that correlation index, KOR1M, that was sitting at a calm swan-like 4 or 5? It violently shoots up 71% in a single day to hit 7.3.
Yeah. Right, the dispersion is gone.
Suddenly, every stock is dropping together at the exact same time.
The mask was ripped off, and the true risk of the market was finally exposed.
It's brutal. And by Friday, the sheer concentration of this negative flow is almost unbelievable. The sources note that a whopping 83% of all the negative equity options flow in the entire market was coming from Tesla alone.
83% from one stock.
Yeah, that amounted to negative $1 billion of dealer delta selling just from Tesla. One single stock dragging the entire dealer hedging ecosystem down with it.
And we really must broaden the context here because, as the notes point out, it wasn't just tech pulling the market down. The fundamental match that started this fire wasn't burning in a vacuum.
Right.
The macroeconomic environment was quietly turning deeply toxic while everyone was distracted by those tech earnings.
Yeah, the sources are full of warnings about the macro data. Crude oil was trading over $90 a barrel, which was 28% higher than just the beginning of July.
Significant inflation risk.
And the U.S. 10-year Treasury yield hit 4.7%, which the notes point out was its highest level since January 2025.
Right. Higher oil means higher inflation risks, which means interest rates might stay high. Higher treasury yields put immense pressure on stock valuations, especially growth stocks like big tech, because it just makes borrowing money more expensive.
So they get squeezed from both sides.
Exactly. So you have a fundamental macro deterioration combining with poor earnings, plunging directly into a negative gamma options environment where dealers are forced to sell. It is the absolute perfect storm.
So as this brutal week in July 2026 wraps up, the sources look ahead to the following week, and the calendar is just heavily stacked with even more fundamental matches.
It is a catalyst-heavy calendar, which is incredibly dangerous when the market is trapped in that short-circuiting negative gamma state. The notes highlight an upcoming FOMC decision on interest rates from the Federal Reserve. We have more Magnificent Seven earnings on deck: Microsoft, Meta, Apple, Amazon.
The heaviest hitters in the index.
And perhaps most importantly, there's a Bank of Japan rate decision looming. The sources explicitly point out how eerily the setup echoes the August 2024 Volmageddon.
Okay, I see the notes bringing up the Bank of Japan and this phrase, yen carry trade unwind.
Yes.
That sounds like something straight out of an international finance textbook. What does that actually mean for, my portfolio?
Well, the yen carry trade is actually a beautifully simple but dangerous mechanism. For years, interest rates in Japan were essentially zero. So massive global hedge funds would borrow Japanese yen basically for free, convert it to US dollars, and use that money to buy high-flying tech stocks like Nvidia or Apple.
Oh, wow. Free money to buy tech.
Right. But if the Bank of Japan suddenly raises interest rates, yen gets more expensive. Those hedge funds are suddenly losing money on the loan. To pay it back, they are forced to sell their U.S. tech stocks all at once. That's the unwind.
So it's essentially a global margin call.
Exactly. Back in 2024, a surprise shift from the Bank of Japan triggered exactly that, crashing markets globally. The fact that the sources are drawing that parallel, while the market is currently sitting in a fragile, avalanche-driven negative gamma state, It's a massive warning siren for anyone paying attention to the plumbing.
It wasn't all just doom and gloom, though. I do want to point out one rare bright spot the sources mentioned, just to show how granular this gets.
Sure.
Amidst all this Friday chaos, Intel actually jumped 7% post-earnings. The notes highlighted that their specific options positioning had actually been constructive before the report. So it just proves that even in an avalanche market, individual mechanics still matter if the setup is right.
It highlights that gamma isn't just a macroeconomic force. It is hyper-local to individual stocks as well as the broader index.
So what does this all mean for you? If you are listening to this, preparing for a morning meeting, managing your own retirement portfolio, or just trying to make sense of why the financial news seems so disconnected from reality sometimes. The big takeaway from these sources is that being well-informed isn't just about reading a company's balance sheet anymore.
No,
It's not just about knowing if Tesla hit its delivery targets or if inflation ticked up 0.1%.
Those fundamental metrics are just the headlines. They are only half the story.
Exactly. Understanding this invisible architecture, knowing what delta hedging is, knowing where the gamma levels sit, watching the correlation indexes like KR1M to see if the swan is paddling furiously underwater, that is what separates the reactive observer from the truly informed learner.
Right.
When you know where the risk pivot is, you know whether the market is bowling with the bumpers up or whether the ship's pumps are about to short circuit.
I think it goes back to our central thesis. You must respect the mechanics of the market. Fundamental news will always light the match. A missed earnings report is a real event.
Yep.
But you will never, ever understand the magnitude of the ensuing fire unless you know how the options market is structured. You have to know how much gasoline the dealers have poured on the floor.
It completely changes how you watch the financial news, doesn't it? It makes you look past the headlines and straight into the gears of the machine. Which leaves us with a lingering thought for you to mull over as you look at your own portfolio today. Is the hidden plumbing of dealer positioning, hedging algorithms, and options expirations ultimately dictates the speed and the violence of market crashes? Are we actually trading the market anymore? Or is the market's invisible architecture trading us?